RZLV AI PLC, trading under the ticker RZLV, is currently priced at $2.84, reflecting a significant intraday drop of 7.05% as of 11:47 a.m. GMT-5 on this Monday, December 1st, 2025 trading session. The common expectation when an AI-focused growth stock announces a major acquisition is a corresponding pop in the share price, driven by the narrative of scale and accelerated growth potential. Yet today's trading chart shows a sharp contradiction, confirming the tension between market expectation and financial reality. The stock is sliding backward, dipping below its previous close of $3.05, despite the company publicly announcing a significant, immediately EBITDA accretive deal. This unexpected bearish reaction immediately raises questions for investors. Is the market pricing in a deeper, more worrying financial liability, or is this simply a knee-jerk dilution fear that presents a short-term buying opportunity for those with a longer time horizon? The reality we must explore is that while management may see a strategic homecoming and a powerhouse asset, the street is fixated on the price tag and the balance sheet risk, specifically the assumption of a considerable $150 million in debt. The recent news that RZLV AI is acquiring CrownPeak, a digital experience platform, for an initial $90 million, composed of $50 million in cash and approximately $33.9 million in equity, is the primary catalyst for today's price action. Management is selling this as a transformational move, positioning RZLV to rapidly expand its brain commerce footprint across key regions and integrate its proprietary AI-driven solutions like the Brain Suite into CrownPeak's established blue-chip customer base. The acquisition is touted to bring roughly $70 million in expected annual revenue immediately, which is substantial, and to be immediately accretive to EBITDA. This aligns with the common expectation for an AI company: use capital to acquire scale, customers, and data to grow faster. However, the market's skeptical reality check is centered on the $150 million in debt that RZLV is also assuming as part of this transaction. For a smaller, growth-focused AI company, this level of debt assumption changes the risk profile dramatically, introducing financing concerns and integration hurdles that overshadow the potential for revenue synergies. High trading volume today, pushing the stock from an open of $2.94 down to a low of $2.79 before consolidating slightly, indicates heavy selling pressure from investors who are clearly uneasy about the immediate financial obligations, suggesting that the initial shock of the debt load outweighs the positive long-term narrative for the moment. Shifting the lens to the technical and speculative side of the trade, it is crucial to understand the short selling interest in RZLV. The latest available short interest data indicates that the stock is indeed under pressure, with a short interest percentage of the float sitting at approximately 10.14%. While this figure is not in the extreme territory that signals an imminent massive short squeeze, it is certainly significant enough to affect the daily price action, particularly on a day like today with major news. The days-to-cover ratio, which is around 1.06, suggests that the short positions could theoretically be covered quickly if a sudden positive catalyst appeared, but this ratio has historically fluctuated, indicating tactical positioning by sophisticated funds. The volume of off-exchange short selling, including dark pool volume, is also noteworthy, comprising about 41.90% of the total short volume. This high off-exchange figure points toward institutional firms actively deploying bearish strategies, often related to managing risk on larger positions or engaging in arbitrage, and it contributes to the downward pressure on days when market sentiment turns negative. Citadel Advisors LLC, for instance, is a major institutional holder, but also appears in filings that suggest significant options activity, including puts, which can be interpreted as either hedging or a direct bet against the immediate price direction. Alyeska Investment Group is another large holder to watch. Investors need actionable steps to navigate this short-selling environment. First, track the short borrow fee rate, which has recently been volatile, fluctuating between roughly 3.73% and over 5% in recent trading days leading up to this week. A sudden, sustained spike in this rate would signal rising conviction and tightness in the availability of shares to short, which is a precursor for a potential short squeeze. Second, monitor the failures to deliver data as it becomes available. Persistent high FTDs can suggest naked shorting, which is a major point of discussion in retail forums, though it is technically difficult to prove. For the time being, the short thesis is clear. RZLV AI is an unprofitable, high-growth AI company attempting a large, debt-heavy acquisition in a choppy economic climate. The counter-thesis, which is management's narrative, is that the acquisition of Crownpeak is fundamentally accretive, adds substantial recurring revenue, and provides a clear path to cross-sell a high-margin AI product to a large, captive enterprise customer base. Retail investors should carefully consider the dilution risk posed by the equity component of the deal and the potential need for future financings to manage the new debt load. What's your take on the rising short interest, smart money, or a strategic hedge? Please comment below with your thoughts. Zooming out to the bigger picture, RZLV AI's core business revolves around its proprietary AI-powered commerce solutions, primarily its Brain Commerce platform. This platform is designed to simplify and automate transactions using conversational commerce, visual search, and its proprietary large language model, BrainPower. The pitch is compelling, moving commerce from a search and click model to an agentic, conversational one. They have established partnerships with industry giants like Microsoft and Google, which adds a layer of credibility that many speculative stocks lack. Earlier this year, the company had been aggressive in its growth narrative, citing the attention given to agentic commerce by figures like the CEO of Amazon, and had previously acquired SmartPay and Subsquid to bolster its offerings. The expectation baked into the stock price, even at these lower levels, has always been tied to a massive multiple expansion as the market recognizes the value of its intellectual property and rapidly scaling annual recurring revenue, or ARR. Indeed, the company had been highlighting a significant valuation disparity, noting that it traded at around 17x ARR based on its prior projected $100 million in ARR for 2025, compared to some privately held peers trading at 36x to 100x revenue. This disparity was the main driver of the positive sentiment that attracted large institutional investors like BlackRock, Citadel, and Alyeska in the first place, as documented in their 13F filings. The $90.85 million market cap, when viewed against the $70 million in annual revenue expected from Crownpeak alone, suggests a deeply undervalued scenario if the deal executes perfectly and the new revenue streams are sustained. However, the operational reality of managing $150 million in new debt, which is a sizable figure relative to the market cap and a substantial increase from its prior total debt of about $3.41 million as of the last quarterly report, is why the stock is selling off. Investors are worried about the servicing cost of that debt, particularly in a high interest rate environment, and the possibility of future asset sales or further dilutive equity offerings. The company's financial statements for the period ending June 2025 showed a net loss of $28.93 million and negative cash from operations of $9.90 million, demonstrating that it is far from profitable on its core operations. The expectation is high-growth, AI-driven profit. The reality is an acquisition-led growth strategy that dramatically increases the company's leverage and financial complexity. Looking toward the future, the primary catalysts for RZLV will center entirely around the Crownpeak integration and the successful cross-selling of its AI tools.
Management projects the deal will be immediately EBITDA accretive, meaning that Crown Peak's operating profit is expected to immediately add to the combined entity's EBITDA, which could help offset RZLV's prior losses. This is the crucial metric to watch in the coming quarters. Any sign of smooth integration, successful debt refinancing, or early material wins from cross-selling the Brain Commerce suite to Crown Peak's client base, which includes major global brands, would serve as a massive upward catalyst and could force a reckoning among the short sellers. Conversely, any news of integration delays, customer churn at Crown Peak, or an inability to manage the debt obligations would confirm the short thesis and lead to further downward revisions. The general trading trend has been volatile, with a 52-week range of $1.07 to $8.45, showcasing the extremely high-risk, high-reward nature of this security. Institutional ownership has recently surpassed 10%, indicating that smart institutional capital is split. Some funds, like Susquehanna, are holding substantial long positions alongside their hedging put strategies, while others are clearly taking a more cautious stance given the recent dilution